Hey everybody, I'm John Van Duzer, CPA and partner with James Moore and Company, and I'm here with Daniel Rocani and Elena Davis, and we're your Biden tax update crew. And we got another weekly update for you. If you didn't catch our video last week, definitely want to catch it. We talked about all of the proposals around the so-called billionaire tax. And this week, we have some huge news coming out of Congress. So I want to just be able to dive right in. On October 28th, the House Rules Committee released an updated version of the Build Back Better Act, which is the reconciliation bill. So this is the bill with the core of all of the tax changes. And the updated version has some massive changes to kind of the whole philosophy of what they were aiming for on the taxes. So with that, Daniel, why don't you walk us through what items were in the original bill and the original proposals that we've been talking about this whole time, and now they're excluded from the update?
Right. So because there was some pushback from some senators about basically tax increases, there's a lot of stuff in this original bill not included in this update. Some of the really big ones that we've talked about in the past. So the big ones is tax rate increase, and we're talking about corporate, individual, and capital gains. They are all not in this bill anymore. So the corporate one was supposed to be increased to 28%, still at 21%. The ordinary top level was going to be at 39.6%, staying at 37%. The individual capital gains and qualified dividends was going to be increased to 25%. It's still staying at 20% for all three of those. So it's a pretty big difference.
Yeah, and that's a result of Senator Sinema from Arizona, who basically said, "I'm not voting for a bill with tax rate increases. You got to fund it a different way."
Right. Now, there's still also other rich stuff in the original bill that is not included in this one. A really big one we've talked about is the carried interest. I'm actually surprised this one is being removed, but it's staying at 3 years. They wanted to increase that to 5 years to basically get that capital gains rate. Another big one is limiting the deduction on qualified business income for certain high income individuals. This was like $400,000 limit income. They were going to they're basically going to limit how much of that QBI deduction you can take. That's all the way out now too. And then there's a lot of changes back to these grantor trusts. They've been talking about this and the estates and everything. So the rules they were trying to change to applicable to grantor's trusts for estate purposes, the valuation of transferring non-business assets or investments, increase in limits on estate evaluation reductions for certain real property. These are all out of this new updated bill. And then a big one is they're trying to terminate the temporary increase on the unified tax. This is the estate tax that's currently at 11.5 million. It's still going to end currently at 2025, but they were trying to end it early. That's going to stay there for right now for the foreseeable future.
Right. So based on this bill, if this bill were to be passed, basically a lot of the things that we've been talking about for the last year aren't going to be an issue, right? So tax rates themselves are not necessarily going to go up. The estate tax exemption is going to remain intact, and some of these other provisions that affect estate planning aren't going to change either. So it seems like there's a huge moderation of this bill based on these changes. So Elena, they had to fund their spending somehow. So we also added some things that were not in the original bill. And so you get to be the lucky person to walk us through these because they're pretty complicated.
Absolutely. So yes, they do have to come up with money from somewhere. And now the focus is shifting from just blanket increase of taxes for all corporations and individuals earning over 400,000 to really going after this large corporations, the international corporations. One of the new type of tax that they're introducing is that so-called alternative minimum tax on corporations' financial statements income, or so-called book income. So the proposal here is to apply a minimum of 15% tax on corporations' book income, and the affected corporations would be those whose average 3-year earnings exceed $1 billion. So really, really large companies here.
there's a dynamic with those really large companies that, through very, very sophisticated tax planning and strategies, they're able to basically pay zero tax, right? And so
Absolutely.
that's been a given for a long time. And so what they're doing is saying, hey, we need you to pay some level of tax. And so they're creating this mechanism to do that. And frankly, it's something that's probably going to be super, super complicated and is going to be, but it's only absorbed by the very few corporations out there that have an average income in excess of $1 billion. So it's going to be a heavy, heavy burden on a very small group.
Absolutely, yes. And another type of tax that they're introducing is the excise tax, a 1% excise tax on corporations who buy back their own stock. Right? Those big publicly traded company, again, will be affected, not the small businesses. Um, Most of these provisions, they will allow a 1 year deferral and will take effect January 1st, 2023. Another type of tax that is changing that will affect the international corporations and domestic corporations who have any kind of international type income, right? We're talking about BEAT rate is going up. That stands for Base Erosion and Anti-Abuse Tax. That type of tax was introduced back in 2017 with Tax Cuts and Jobs Act and was geared towards this international corporations who have a tendency to shift some of this income out of the United States, thus avoiding the domestic tax liability. So the rate of that type of tax is going up by 2% and 5% and so on, and eventually reaching 18% in 2025. Then because of some of the deductions for this global intangible low tax income, the limit on these deductions, the effective rate for guilty, so-called guilty tax is going up to 15%, and the rate for foreign derived intangible tax, the FDII, is also going up. So again, the big shift towards the international corporations who have more sophisticated methods of trying to hide this income from the United States. And now this is a big change for corporations, this large companies. Now on the individual level, yes, the subject of increase in the marginal tax rate is currently off the table, but they're introducing a new type of surtax that will affect individuals whose modified adjusted gross income exceed $10 million. They will be subject to additional 5% tax. And then on top of that, if the modified adjusted gross income exceeds 25 million, then there will be additional 3%. So this will affect very wealthy individuals, not just everybody across the board, and also estates and trust.
And this is an area, and we'll dig into this probably more in future weeks, but this could really affect trusts because trusts often have different thresholds for the tax liabilities. And so, for instance, like for income tax rates, they hit the maximum rate at like $10,000 of income. So this is an area that could disproportionately affect trusts. So it's something we're looking into and monitoring, and we'll report back, but could definitely impact a broader group than just the initial or the surface. Okay, I don't make $10 million, I'm good. So kind of just a few quick observations. Again, this bill seems to be shifting from Main Street to Wall Street, right? We're targeting the largest corporations. We're targeting the wealthiest Americans. We're going after a really small group and really shifting that burden to them. Many of the provisions in the Tax Cuts and Jobs Act in 2018 are set to sunset in 2025 anyway. So for example, like that estate tax exemption we mentioned and the qualified business income 20% deduction and bonus depreciation. So they're basically leaving those intact, but they're set to sunset in a few years anyway. So it's not a permanent provision, but it's something that will need to be addressed down the road if those deductions are going to be allowed to be sustained. And then the other kind of word of caution is, even though today those provisions aren't in the bill, that doesn't mean that they're completely off the table, right? And so historically, Congress has had negotiations like this. They've taken provisions out and they've either put them back in at the 11th hour, or they slipped them into another spending bill or another bill entirely. So just want to kind of give that one word of caution that, okay, the estate tax is fine for the few years on the surface. That doesn't stop in December from it changing again. So, you know, we definitely need to keep on monitoring this and watching out for what can happen, because, you know, it could change again. Just as quickly as it got out, it can get put back in. So that's all the time we have for today. So definitely stick with us and keep watching these videos, and we'll keep reporting back as things evolve. Thanks, guys.